Hello everyone, this is Madhvi Mehta from Kotak Securities Commodity Research Team, and I'll be discussing the outlook for major non-agriculture commodities. Well, it was another week of losses for commodities as growth worries were coupled with monetary tightening expectations. Firmness in US dollar and weaker risk sentiment also weighed on commodities. Industrial metals continued to be the worst performers, reflecting wariness about economic activity. Gold and silver also plunged on tightening expectations. Crude oil witnessed mixed trade but ended higher, while natural gas ended lower for another week. The US dollar index ended modestly higher last week, reversing the losses noted a week ago. The US dollar index has turned mixed as support from safe haven buying and Fed's tightening monetary expectation is countered by concerns about health of US economy and drop in bond yields. After a brief rebound on dip buying and quarter-end position squaring, equity markets came under renewed selling pressure amid growth worries and prospect of higher borrowing costs. US DJI index ended lower, marking its fourth decline in 5 weeks. European and Japanese equities also ended lower. Chinese equity markets were the outlier as Shanghai Composite ended higher for the fifth consecutive week. The gains in Chinese market reflect shift in investor flow amid expectation that economic activity may pick up pace once virus-related restrictions are eased. Apart from Chinese markets, buyers also shifted focus towards bond market as they looked for safe havens amid increasing growth worries. The US 10-year bond yield slipped below the key 3% level and tested the lowest level since May. European bond yields have also come off the highs. With continuing debate about implication of monetary tightening on economic growth, comments from central bank officials indicated that they may continue with monetary tightening to get inflation under control, even if it results in slower economic activity. Fed Chairman Jerome Powell said he was more concerned about the risk of failing to stomp out high inflation than about possibility of raising interest rate too high and pushing the economy into a recession. ECB president said they were ready to raise rates at a faster pace if needed if inflation continues to shoot higher. Bank of England governor remained non-committal about future moves, saying that they may not necessarily have to act forcefully to get inflation under control. However, market expectations show they are expected to make bigger moves. Some other central bank officials also expressed concerns about persistent inflation and the need for monetary tightening. While central bank officials have maintained concerns about inflation and the need for tightening, mixed economic data indicated increasing stress on major economies. US consumer confidence and manufacturing PMI fell more than expectation, while first quarter GDP was revised further lower and personal spending rose at a slower pace. German unemployment also unexpectedly rose last month. Inflation data, however, painted a mixed picture. Eurozone consumer prices rose at a record pace last month, while German consumer prices rose less than expectation. US core PCE price index, which is Fed's preferred inflation gauge, rose at a slower pace. Correction in commodities at large also eased inflation concerns to some extent. Overall, there is no change in market expectation that monetary tightening may continue unless there are clear signs of easing price pressure, and this may hamper economic activity. Market players may, however, continue to react to economic numbers and central bank comments. Also in focus is China, as market players are trying to assess how fast the economy could recover once virus-related restrictions are lifted. Firmness in Chinese equities and recent gains in Chinese yuan show increasing optimism that the economy will recover soon. However, there are still inhibitions owing to China's strict adherence to zero COVID policy. Data released last week showed manufacturing and services PMI have moved above 50 level, indicating expansion in the sector. However, manufacturing PMI improved less than market expectation. On virus front, Beijing and Shanghai reported no new cases for the first time since February, resulting in some easing of local restrictions. China also reduced quarantine period for inbound travelers to boost economic activity. However, market sentiments got a hit as Chinese president maintained his support for the COVID policy. While market focus is more on inflation, monetary policy, and China, Russia Ukraine war continues to intensify and supply risk persists for commodities. Reduced Russian gas supply has kept European gas prices near March highs, while crude oil has turned volatile as G7 nations discuss putting a cap on Russian oil prices. Going ahead, we may see volatility continuing in commodities, reflecting the general nervousness in larger financial market. Focus will continue to be on economic data from major economies, central bank comments, as well as virus situation in China and Russia-Ukraine fighting. The key event for the coming week includes FOMC minutes and US non-farm payrolls report, US economic data, and central bank comments will help form expectation as to how long Fed will continue with the rate hikes. US non-farm payrolls report is expected to show slower growth in jobs market, reflecting increasing stress. However, one negative reading may not change Fed's outlook significantly. ECB monetary policy account will also be watched for more clarity about ECB's future move. Market players have already factored in the possibility of a hike in July. Also in focus will be China's inflation data and services PMI reading from across the world. Let us now start with individual commodities, and we'll start with gold first. COMEX gold ended lower for a third week and tested the lowest level since late January. Gold came under pressure amid firmness in US dollar, monetary tightening stance of major central banks, continuing ETF outflows, and Indian government's decision to raise import duty on gold. Gold, however, managed to gain some support and hold near 1800 level amid lower bond yields and increasing growth concerns. Gold may remain choppy with mixed factors in place. However, Fed's tightening expectations may keep US dollar supported, and this may pressurize gold prices. In domestic market, the band of gold price has shifted upwards due to the change in import duty. However, the trend in price will continue to be determined by trend in international prices. The trading range we see for the week is 50,600 to 52,900. Moving to silver, COMEX silver fell sharply last week as it faced the brunt of sell-off in both gold and industrial metals. Firmness in US dollar, Fed's tightening outlook, and global growth worries weighed on silver prices. ETF outflows also showed weaker investor interest. Silver has fallen sharply in last few sessions. However, the sell-off seems little overstretched, hence which suggest waiting for corrective rebound before creating fresh short positions. The trading range we see for the week is 55,500 to 60,770. Moving to industrial metals, let's start with copper first. LME copper prices slipped below 8,000 level for the first time since February 2021 as recession concerns continue to weigh on global demand outlook. A rebound in Chinese manufacturing and services PMI in June hinted towards improving economic activity but was unable to boost prices amid stronger US dollar and limited global risk appetite. Going ahead, copper may remain under pressure as investors cautiously await FOMC meeting minutes and the crucial US labor market report for hints on policy trajectory. However, sharp downside may be limited by China's efforts to boost economy via infrastructure stimulus as it begins to ease virus-related restrictions. The trading range we see for the week is 648 to 721. Moving to aluminium prices traded in a broad range of $2,400 to $2,500 as lower premium in Asia's biggest importer market, Japan, coupled with stronger dollar weighed on prices, while consistent decline in LME inventories to the lowest level since January 2021 lent some support. For the third quarter, Japan is reportedly set to pay a premium of $148, which is the lowest in more than a year owing to waning demand from automobile sector. Going ahead, aluminium may trend lower as seasonal low demand in China may exert pressures, though falling LME and Shanghai inventories may limit any major downside. The trading range we see for the week is 200 to 228. Now let's talk about zinc. Zinc was a worst performer in the sector and fell to 9-month low below 3,000 level as demand concerns outweighed expectation of lower output in China in the near term. Chinese output is expected to fall amid rains in June and routine maintenance in some northern smelters from July to August. As a result of the sell-off, LME cash to 3-month spread, which saw the 25-year high backwardation of around $218 per ton, has now narrowed to about $25. Going ahead, zinc may remain under pressure amid gloomy outlook for steel industry. China's steel market PMI fell deeper into the contraction territory last month, even as manufacturing PMI jumped back above 50 level, indicating expansion. The trading range we see for the week is 264 to 295. Lastly, let's talk about lead. Lead prices held steady as the supply of both primary and secondary lead continued to decline in China. Also, SMM reported the social inventory of lead ingots fell across major centers by 400 metric tons to 84,500 tons. Despite supply issues, lead may remain under pressure amid weaker risk sentiment with focus on FOMC minutes. The trading range we see for the week is 168 to 182. Moving to energy complex, let's start with crude oil first. Crude oil witnessed mixed trade but ended modestly higher marking its first gain in 3 weeks. Crude oil was volatile as supply risk countered demand concerns, and this trend may continue in the near term. Mixed economic data from major economies and increasing discussions about recession has dented demand outlook. Supply risks are high as G7 countries are working on ways to impose a cap on Russian crude oil. Supply disruption relating to Libya and Equator and strike concerns in Norway also lend some support to prices. Prospect of higher supply from Iran were also impacted as talks to revive the 2015 nuclear deal ended without any major breakthrough. Crude may remain volatile as supply risk may keep a floor to prices while demand concerns may limit any major upside. However, we recommend selling at higher prices amid increasing challenges to global economy. The trading range we see for the week is 8,100 to 9,000. Lastly, let's discuss natural gas. NYMEX natural gas fell sharply last week, marking its third consecutive decline and tested the lowest level since March. Natural gas has been falling for last few days as closure of Freeport LNG terminal in Texas has diverted more supply towards the US market, and this is evident from drop in LNG exports as well as bigger than average buildup in gas stocks. However, supporting price is robust weather related demand in US due to hot weather in some parts as well as higher European gas prices. Natural gas has continued to set fresh lows indicating weaker sentiment. However, with increasing volatility across energy sector, one must wait for corrective rebound to create fresh short positions. The trading range we see for the week is 400 to 524. Well, that's it from my end. I wish you all a very happy trading week. Thank you.